Okay, so on to the session. So first of all, on behalf of your advisors and the whole team here at Endorphin Wealth, we're really excited to have you along today. So thanks again for making time. We are really excited to bring this session to you. We think the the financial and market update that we're going to do today for our clients, we think it's really very timely and very topical. So we're sure you'll get plenty of value from it as well. We're also really excited to have Isaac Poole, the Chief Investment Officer of Oreana Portfolio Advisory Services, here presenting the content today, and more on Isaac in a moment. In terms of Oreana Portfolio Advisory Services, to give you a feel for who they are, they're really important business partners of Endorphin Wealth. They essentially provide specialist investment capability to our business and to our clients, and they're also on our investment committee as well and provide insight and expertise. They've got offices here in Melbourne. They've also got offices in Hong Kong, so they bring this global specialist capability to our business, which we really value. We are, from a practical point of view today, allowing space and time for your questions. The way we're going to do that is through the chat function on Zoom today. So if you just click onto chat, you'll see you'll have an opportunity there to just really ask questions as the presentation goes on. We will bookend those and let Isaac finish his presentation, and then we'll pass those on to Isaac for answering. So yeah, feel free to start to get those questions going as the content goes through. And then on to Isaac. As I said, Isaac's the Chief Investment Officer of Oreana Financial Services. Isaac's a very experienced investment professional with a career spanning Australia, London, Hong Kong, also with a PhD in economics from the University of Sydney. His wealth of knowledge in economics and markets has been gained from experience as previous head of capital markets research in Asia Pacific with Willis Towers Watson, and chief economist of the New South Wales Treasury Corp prior to joining Oreana Portfolio Advisory Services. So again, we're very excited to have Isaac here today. And I will now pass over to Isaac to take us through the update. Thank you, Isaac.
Great, thank you very much, Rowan, and share my my slide with everybody. Hopefully that comes up nice and clear now for everyone. So thanks for the introduction. Thank you everyone for joining us. It is really great to be able to join you all virtually with Endorphin. I'm coming to you from Tasmania, where I've been based for a little while, and I'll be relying on the National Broadband Network to get us through this, where hopefully I can share some thoughts on the economy, some thoughts on markets, what's going on, what the outlook we're facing is, and from my perspective, it's always a joy to be able to join groups like this and share some thoughts and really speak to you all. And I encourage you to send questions through to Rowan, and I can have a go at answering them at the end. So there's my background. Rowan's already done me more than enough justice. Thank you. So it's been an unusual year, and that is putting it mildly. Let's face it, there's so much to talk about, so much to cover. We only have a limited amount of time, so I've selected a few areas to focus in on to get us through the next half hour or so. So we'll take a look at the historical context for 2020, where we came from. We'll take a look at the virus, because it's been a very important part of the uncertainty we've seen in markets this year. And then we have the election. The major media circus that we had around most elections was even more so for the period leading up to November 3. And we'll share how we thought about that and what we see the outlook as a result of the likely outcome. And of course, we'll talk about Australia and housing and what all of this economic outlook means for markets. So that's the path we'll take over the next half an hour. So let's jump into it. The historical context, 2019, we came into 2020 with equity markets on a tear higher. They were climbing almost linearly higher through the fourth quarter of last year, and equity markets were having a great run. And does that mean that everything was rosy in the economy? And that's the question that we were asking ourselves at the time, and we basically came up with the answer that no, it was not all rosy. The world and the world economy was a very fragile place. Markets just had not grasped it yet. There were risks everywhere. And we thought that was an environment that was full of downside risk and full of uncertainty. And we came into 2020 explicitly expecting a recession to take place over this year. Now, we got a recession, and it's been a terrible recession, but we didn't get it for the reasons we thought. We absolutely did not expect a pandemic to tear through the world. But we were worried about these downside risks. And what I think is useful is to explain and give context about why we were worried about those risks. And the point is, the world was already in industrial recession. We had a situation where manufacturing and investment was contracting everywhere across the world. So if we look here at the US, industrial production was 1.5% lower than a year earlier. In the UK, 3.9% lower. Germany, which is one of the world's largest manufacturers, had industrial production that was 5.5% lower. And in Japan, another really large manufacturer, almost 8% lower than a year before. This was a deep, painful industrial recession that was already taking place. And that means we had a very fragile global economy at the end of 2019, and risks were skewed to the downside. They were squarely skewed to the downside, and we were very worried about that. And we saw this disconnect between the economics of the world and what was going on in markets. And so, to paraphrase, I guess, the Game of Thrones and those who enjoyed watching it, we thought winter was coming. There was a recession on the horizon, and we wanted to start getting prepared for it. And the issue was that this was a fragile economy and a fragile world, and unfortunately, central banks had very limited ability to be able to support that fragile economy. You can see here in this slide that the US was one of the only major developed central banks with rates above 1%, very low from a historical perspective. And other countries had even less ability to support the economy if there was a recession. You can see Japan with a cash rate around 0.1%. Australia was at 0.75%. Europe had negative cash rates. So were we worried about 2020? Absolutely, you bet we were. It was an outlook for us that looked very worrying. Now, 2020 delivered on our concerns and then some. It's been a deep recession, even worse than we'd expected. And we used this quote back in one of our notes in November 2019, so about a year ago. Only a year. It seems almost a lifetime ago. But the quote is, "It's not the speed that kills; it is the sudden stop." And Rudy Dornbush and his team wrote this about the Mexican peso crisis back in the 90s, and it could not be more relevant for 2020. Because what we saw at the start of this year, or in the first half of this year, was a classic sudden stop. It was quick, it was painful, it was brutal, and it gave us one of the worst recessions in global history. And we're really just now starting to get a sense of how bad that recession was, what some of the implications of that recession are, and just how long it might take for this sudden stop to pick up and reverse itself. So let's start off by just asking ourselves, what does a sudden stop look like? Because it's probably a term that isn't used very often. We usually talk about recession or depression, but this is different. It was a sudden and painful stop in economic activity throughout the world. Now, we've all lived through this sudden stop now, and up until now, most people in a developed world have not lived in a sudden stop. It usually only happens in emerging markets, but we've lived through it. Some of us have been in lockdown and have felt this very painfully. But it's useful to look at some of the numbers from around the world, because it really does put what a sudden stop is in very stark relief. So let's look at some of these numbers. The aviation sector is a classic example of a sector that had a very sudden stop. It was hit very badly. Passenger traffic collapsed. The numbers were horrifying, and there was still some container traffic that was going on, and some passenger planes were converted very hastily to container commercial aircraft. Otherwise, this number here, 75% decline in commercial traffic worldwide, would be even worse, and it's a bad number anyway. And as a result, governments had to step in and they supported the national carriers. Otherwise, we would have been facing an aviation sector collapse. Almost $140 billion of support committed to airlines to keep them from going bankrupt and keep them solvent. But it's not just the aviation sector that had a sudden stop. It was most of the logistics areas and road traffic as well collapsed. So here we see that in the UK, as a result of widespread lockdowns and quarantines that were implemented, car registrations dropped 95% in a month compared to a year earlier. And this is a real example of activity absolutely falling off a cliff, a real sudden stop. It was more widespread than just logistics and transport. Lockdowns and the fear of getting out in public had a devastating impact on the retail sector. We saw it in Australia, we felt it in Australia, but in the US, this is really critical because retail sales fell 20% compared to a year before at the worst month. And this is in a country where consumer spending is about 2/3 of GDP. And this means that the US economy effectively moved towards a standstill. It was a sudden stop in the classical sense, and we had it in the export sector where exports were almost 30% lower. They've been slow to recover. This has been a global trend, and when you look at the world GDP forecasts coming out of the OECD, they're forecasting for this year 4.5% to 6% contraction in GDP. Now that's a recession, well and truly, because what we should remember is that the OECD and the IMF would normally think of a global recession being growth of 2% to 2.5%. That's a global recession. A collapse of 4.5% to 6% is off the charts. It doesn't happen. This was a sudden stop. It's painful, and it's resulted in a severe stop in economic activity. Now, we had this sudden stop. It resulted in rampant uncertainty around the outlook. We had questions like, is the virus going to mutate? Is it going to be seasonal? What's the infection rate? What's the hospitalization rate, the death rate? Are lockdowns effective in controlling it? All of these questions were sort of ramping up during that period of February, March, April, and onwards in Australia, where we had lockdowns for a very lengthy period. And these questions were very, very difficult to answer because the answers were largely unknown at the time. We were in a period of radical uncertainty. One of the key questions was, when will a vaccine be available? And again, we just didn't know. So we had governments around the world taking action to try and contain the spread of the virus, and that probably helped. It's hard to do a counterfactual, but it definitely deepened the recession. And now we're looking at more restrictions potentially in the Northern Hemisphere, the UK and the US, and here in South Australia, we have announcements yesterday about more targeted restrictions, and that means that a vaccine is critically important to be able to give confidence back and to be able to get markets back open. And to be honest, markets became really pessimistic about the likelihood of a vaccine by year end. Around June this year, there was a wave of optimism. Markets were saying, and surveys were saying that there was an 80% chance of a vaccine by the end of 2020. That dipped over July and August and September to people thinking there was an even chance of a vaccine by the year end. Then we had the then we had the election, and I'll talk about that shortly. And no one can focus on the vaccines, but then we started to get some great news last week. We had Pfizer announce its trial results, and they were better than anyone could have expected, and that's great. It means we still have some external reviews to take place before it can be approved under an emergency process, and then the drug can be released, and expectations are that it could be shipped by December. So that obviously is some positive news. Moderna released similar results, and here we have another vaccine potentially available by December. So all of a sudden, a little bit more certainty around the outlook. Oxford AstraZeneca are going to release some results soon, likely by the end of November, and it sounds positive. And there's another 11 candidates in total in this late stage testing for a vaccine. And we suddenly had this wave of optimism about a vaccine and how that might impact the medium-term outlook. But the reality is it's still very uncertain. Between now and the end of December, we have this situation where there's been a spike in infections, a third wave in the US, a third wave in the UK, another round of infections announced in South Australia. We've had a hospitalization spiking, we've had deaths spiking, and all of this is coming at the same time as we know a vaccine is coming. So there's broadly good news over the medium term and less uncertainty over the medium term, but it could still be too late to prevent a double dip recession. In the next 6 weeks, we could see broader and wider restrictions set across the world, and we're not out of the woods yet. That means in the near term, we're not out of the woods. In the medium term, the picture has received a real shot in the arm, and so to speak, and there's a more positive outlook, but there are near-term risks, and we have to be aware of that. And we have to be aware that could result in a lot of volatility in markets and some bad economic data that goes against the recovery that we're seeing. But importantly, from our perspective, over the medium term, we have more certainty, and that's good. So let's move on to the US election, and a lot going on here, and most of it was noise. The lead up to the election was just a noisy period with lots of bluster, lots of tweets, lots of things that weren't really newsworthy, and through all of that, the polls were pretty steady. And so we had this situation where market confidence and investor confidence weakened, and markets became volatile. And then President Trump got COVID and staged a miraculous health recovery. He was back campaigning within a couple of days and out driving with his security guards and all of the things that probably not supposed to do, but he was showing that he could recover. And then markets started to price a blue wave, which was a situation where the Democrats would be able to control both the House and the Senate, and this added to uncertainty and volatility leading into the election. And then we had markets capitulating just before the election, and markets all of a sudden fell 7% in a week, and the noise hit fever pitch, and people had no idea which way the election was going to go after just a week earlier saying it's going to be a landslide victory for the Democrats. So, amongst that sort of noise, you're faced with elevated uncertainty, and our view is you need a framework for thinking about these uncertainties and a way to get through them, because you've ultimately got to invest money, and you need to be able to look through that noise. So we use scenarios to map that out, and we think about what could be and what really matters. And for us, that meant coming up with 3 scenarios, and here they are here. You can see that it's a blue wave, a Democrat president with a split Congress, and a Republican win with a split Congress. And our decision was, let's have a look at what this looks like under each of these scenarios. So taxes, they were going to be higher under a blue wave. Joe Biden said that. He said that very clearly. He promised it. But under the other two scenarios, taxes probably weren't going to change very much, or they were going to be lower. Fiscal stimulus, it was coming no matter who won. So if Joe Biden was the president, and he's going to be, he was going to implement some fiscal stimulus. If President Trump won, he was going to implement fiscal stimulus. The size would be different, but it was always going to be around $1 trillion. That's a lot of money, and that was baked in. Monetary policy was going to be accommodative no matter who was in the White House. The Fed was always going to print money. It was going to implement what they call quantitative easing, throw money out into the economy, prime the pumps with liquidity, and that was baked in. It was always going to happen. Then we have the other policy issues. So US and China relationships, it's been tough over the last couple of years. We've had these tense trade wars, and that's been bipartisan support from the Democrats and the Republicans. So that was going to continue. Then climate change and trade protectionism. A few differences here, but ultimately these are medium-term issues for the economy, and things that we kind of looked at and said, yeah, it'll have some differences. There'll be some sectors that will benefit from this and others that will wear some pain from it. But ultimately, neither of these is going to be enough to shake the US economy off a ongoing recovery. So what's the big picture here that we should focus on? And the big picture, in our view, fiscal and monetary policy, it's going to account for most of the economic growth and momentum in the near and medium term. And under all of these scenarios, it's going to support the economy. So while we saw the noise and the uncertainty, we focused on the big picture. And that big picture, just to quickly highlight how big a deal that is, global monetary policy is extremely accommodative. We can see every major central bank is pretty much have rates of zero, and they're implementing quantitative easing. And this chart puts that in, I think, a very clear picture. We have the range, the 10-year range of the cash rate for the major central banks, and the red dot is where the cash rate is now. You can see it's right at the bottom, and for many it's negative, and for the others it's basically zero. And cash rates are going to stay at those levels for the next 5 years, maybe a decade. It's going to be one of the most accommodative monetary policy settings that we've ever had, and it's going to support the outlook, and it's working already. So if we look at where unemployment was back in February in the US, 3.5%, 3.5% unemployment. It peaked at 14.7% in April. That is a staggering number of jobs lost. Millions upon millions, tens of millions of people out of work in the US. The central bank responded very quickly, and the government responded quickly, and now we're back to 6.9% in October, the fastest unemployment market recovery in the US on history. This is remarkably quick improvement. So we think the US economy is already out of recession. It's not out of the woods. There are risks. There are risks from COVID in particular in the near term. But the medium-term story is the US has escaped recession. It is growing. That recovery will persist. And we think that that medium-term story is a very positive economic story coming off what has been a very challenging 2020. So let's skip away from the US for a second and talk about Australia. And it's a big story because Australia has had its first recession in 30 years. Now, for some people on this call, potentially it's their first recession in their life and maybe their working life. If you weren't living overseas in 2008 and 2009, you may not know what a recession really feels like. And the one that we're going through now is unusual because it's so sharp and painful and sudden, and we're enduring job losses at the same time as we're suffering stay at home and lockdowns. And all of this has weighed on the economic recovery in Australia. It's been a little bit slower than we've seen in the rest of the world. And so it's really important to get a sense of what the outlook is going to be like as we come out of recession, because we are going to come out. And so much of that outlook hinges on the Australian housing market. And it always does. The housing market is a very important part of the Australian economy. And for most of this year, even up till now, the broad consensus has been from the economists at the major banks and the investment banks. The expectation has been that house prices would fall 30, maybe 40% from their peak. And that would deepen the recession and lengthen the recession. And we just disagree. We disagreed back in May when we wrote a note about the Australian housing market. We disagree now. We think that we wrote months ago, we thought that house prices would probably fall 5% or so, but that ultimately by the end of 2021, they would be higher, and they could be much higher. And that's really important because it will drive what is going to happen in the economy. Now, why did we think that? It's because the RBA has a mandate for financial stability, and there was no way in our view that they would let the Australian housing market collapse, because that would be devastating for financial stability. And so we could see that they would take action, and they did. They cut rates. They cut rates aggressively, and they implemented quantitative easing, and that's already helping that Australian housing market. It's helping because of a process that we call the monetary policy transmission mechanism. And you can see here that transmission mechanism works by meaning that every 1% that the RBA cuts rates tends to drive house prices up at least 2%, in some cases a lot more. And we think that will happen now, and we think it will continue to happen over next year. And this time we think it will be even potentially more powerful, because it's coming alongside what we think will be a directive from the RBA to the banks to extend, pretend, and lend. Now, this little trio of words is straight out of the US playbook. It means that banks will be told to extend the maturities of loans to households that are struggling with loan repayments. They'll be told to pretend that loans aren't in default if they're not performing. And importantly, and probably most importantly, is that they will be told to lend to any household that is creditworthy at very low interest rates. And this is going to be a big tailwind for the Australian economy. And it's why we think the recession is over and we're back to a recovery. Now, that is not consensus. Again, sometimes we tend to be out of consensus. So let's summarize where we're different and where we think things are going to go. Now, let's start with unemployment. The broad consensus is that the unemployment rate will rise over next year and keep climbing through 2021. And we're different. We think it's going to peak sometime over the next few months and then really start to drift lower over 2021. So we're a little bit more optimistic. The consensus is that house prices are going to be lower by the end of next year. Again, just said that we just think that is not going to be the case. We think they will be significantly higher than they are now. Now, everything's not rosy for those who think we're just overly optimistic. Wage growth will be weak. It's been weak for a very long time, pretty much since 2008 when we came out of the GFC. Wages growth has been much lower than history, and we think that's going to continue. And it's going to continue because there will be slack in the labour market, and because we don't have the very large sectoral shifts like mining that drove wages higher. And that means inflation will be flat as a result. So the really important parts here are unemployment and housing for the economy. And that means in our view, as the recovery continues, we're going to see more people in jobs, we're going to see rising wealth. That's going to be the basis for a sustainable economic growth outlook in Australia, and that's probably the most positive outlook that Australia has had for about the last decade. Coming out of a short, sharp recession, moving into a period of sustained economic growth is a positive outlook for the economy. So here we have, I guess, what's been a pretty positive view coming from us about the global economic outlook. And the question is, what does that mean for markets? Well, we have really clear views about what that means for markets. And given that we think the economy looks positive, inflation looks contained, house prices are going to move higher, wealth will grow. For us, that leaves some very strong tailwinds for equity markets, and in particular, we think the Australian equities and global equities, particularly the US, are facing a multi-year bull market, where those tailwinds will help propel very solid returns in equities over the next 5 years. They'll be supported by monetary and fiscal policy. Similarly, investment-grade credit is going to perform well, and that's going to be driven by an economic recovery that we think will support corporates and reduce the likelihood of defaults over the next 5 years, and that will give solid returns relative to history. Now, the difference or the negatives are really in global sovereign bonds and the US dollar. So a good economic outcome, a solid growth, means that government bond yields will drift higher, even if the cash rate remains at zero for the next 5 years. And that's going to be a challenge for these bonds returns. And at the same time, because the global economy will be recovering and risk sentiment will be improving and capital flows will be starting to move out of the US into other higher returning places, that means the US dollar is going to face a bit of pressure. And in particular, we think it will face pressure versus the Australian dollar. And that's going to be really critical over the next 5 years. When interest rates are so low, currencies play a big role in your portfolio returns. And so getting a thoughtful outlook on the currency is going to be important. Now, we could literally run an hour-long session on each of these. I could have run an hour-long session on all of the segments that I spoke about, but I've committed to running a half-hour chat about the outlook and the economy and markets, and that's my time done. I'm going to pass back over to Rowan. Hopefully everyone's enjoyed that. Hopefully we've got some questions, and we'll go with them. So over to you, Rowan.
Excellent. Thank you, Isaac. I'm sure everyone's got a lot of value from that. I certainly did. And look, the timing is working well. We're at 12:40, so we've got a little bit of time for some questions and answers, which we will get into. And I'm sure you've got everyone's questions kind of flowing there, Isaac. Just to everyone on the call, a reminder, so the way we're going to do your questions, capture any questions you have, is just use the chat function on the bottom of your screen, and feel free to just start to type those through and hit me with them, and then I'll pass them on to Isaac. So look, as you're getting warmed up for that, I thought I would just get the first question to Isaac. One of the ones that was certainly on my mind is, it's certainly been in the press a lot, in the Australian press, around this fiscal support, so JobKeeper, JobSeeker, and the fact that those are sort of tailing off. They're sort of reduced a little bit, and I think they're going to wind down sometime next year, I think in March. So could you provide some comment about that? What do you expect to happen as that sort of movement occurs?
Yeah, it's a really important part of the recovery, and the support that came through 2020 was that fiscal support. Without it, the economic recovery wouldn't have started so early. We would have had a far more painful recession, even deeper than it was, and it was a deep recession anyway. Now, as you come out of a recession and into the economic recovery, there's a temptation from governments, and it's happened in every recession ever, to start tightening fiscal policy because they can see that growth is picking up and they want to protect their balance sheet and they don't want to go too far into deficit. And so there's a temptation to cut off the taps too early, and we're sort of hearing these timeframes for ending that support. Now, we know that they've already been extended once because it would have just been far too early to turn the taps off, and it would have been a very bad outcome for the economic recovery. Now, I would position those timeframes that are being announced now as conditional, and I think they're conditional on a sustainable and durable economic recovery being underway. And if that's not the case, then I would bet any amount that the government would reintroduce or extend those support measures. Now, by March, is the economy going to be in a durable, sustainable recovery? Well, I think it will be, but will be at the start of that. And so my forecast or prediction would be that there is a good amount of risk that some form of stimulus, it may not be the full package, it may be wound back, it may be more targeted, but some stimulus will persist for some time. And it goes to that old saying that there's nothing so permanent as a temporary government measure. Now, I don't think we'll see the full stimulus, but it will carry on, and that will help juice the recovery, if you like. It will juice up that economic momentum. And our view is that growth next year in Australia might be 5% or so, and that compares to an average over the last decade of around 2%. You know, it's going to be a very powerful recovery, and that I think in itself will give the government some wiggle room to keep that stimulus going on for a bit further, because they'll start picking up receipts and be able to feed that back into their budget.
Okay, makes sense, Isaac. Thank you. I'm just going to have a look at one of the ones that's come through on chat. It's from Shu. How do you think small businesses will fare in 2021 and those looking to start a new venture?
Yeah, great question. And these are questions where there's not a lot of hard data to hang my answer on, but I'm going to use some anecdotal evidence and some data from overseas to help frame it. So what we've seen in the US and in China and parts of Europe is the fastest pace of new business creation on history. It's been phenomenal. Small businesses, they obviously closed at a record rate in March and February, but they've been reopening at an even faster speed. And it's because people have, households have built up war chests of cash. They see an opportunity where others have exited the market. COVID has changed the world we live in. They're seeing opportunities there, and they're starting up small businesses at a rapid pace. And that's really been helping to drive that recovery on in the US. Now, I think Australia is every bit as nimble and smart an economy as the US, and I suspect we'll start to see small business creation really pick up through 2021. I expect that is an area where we could see targeted stimulus from the government as well. It would fit right into the liberal ideology, and that will be another impetus for the economic recovery. Now, it will be challenging because we know that not all businesses succeed, and it will be starting up during or shortly after a recession. But historically, when we look back to the 1990s, we have seen evidence that small businesses that started up during or shortly after the recession got a real tailwind to growth because they were riding I guess a wave of above average economic growth. So I think we'll see a spike. I think we'll see support measures announced for it. And I think that's going to add to the economic recovery that we expect in 2021.
Okay, great. Excellent. And perhaps a little bit related to that question, Isaac, is what are some of the sorts of industries, types of investments that you see doing well over the short to medium term in a COVID normal environment?
Yeah, I mean that it's such a tough one to answer, because while I think household preferences and spending patterns haven't necessarily changed, the way that is done has changed. We hear a lot now in the news and in various areas that technological change and the take up of tech advancements has been brought forward a year or 2 years in many cases. Small businesses are finding new ways to carry out their business. New providers are coming up and helping small businesses carry on their business in different ways. Consumers are interacting with businesses in new and interesting ways. And so there is a whole new part of the service industry that is popping up in Australia and globally, and there's some very large established players in that field. We think of Amazon or Apple, Afterpay, and the groups here in Australia. But then there are a lot of small, nimble areas that are coming up, and they're very quickly getting market share. And in this very low rate environment, I think we'll see more of that as people take risks with tech and with companies. So we've seen tech stocks and the growth sector really rally hard from those very large companies. I think in the wake of that, you're going to start to see this new industry take a little bit of pace up as well, and really start to grow. So there's that area that I think we'll start to see pick up. Then on a more larger picture, financials are an investment sector that has been beaten down very hard because interest rates are so low. Their profitability has been really driven lower by the impact of COVID. Now, we think that's going to change. We actually expect interest rates at the longer end to start drifting higher over the next couple of years, and that will improve net interest margins at banks. And I think you'll start to see a rotation back into the financial sector in the stock market over the next couple of years, and that could be pretty powerful. It hasn't happened for a very long time. Those value stocks and those financial stocks have been out of favor for many years, but we think you're starting to see that rotation begin to take place now, and I think it could be durable over the medium term.
Yeah. Okay, great. So you covered it, in terms of the vaccine, Isaac, and that sort of looks to be on the horizon. But then you also spoke about, some third waves happening around different parts of the world. Could we experience another sharp dip like we saw in March in terms of the markets?
It's a real risk in the near term. That is probably one of the major risks to the economy and to markets. Our base case expectation is that probably won't happen, and the reason for that is while we're seeing a spike in cases and a spike in hospitalizations and deaths, the death rate is decreased, and governments have been really reluctant to shut their economy down on a widespread scale. I mean, it's happening in a more targeted fashion than it was in March, because we know a little bit more. Things are a little bit more certain, how to control it, how to self-isolate, how to socially distance. The Western economies have become a little bit more accepting of doing that and wearing masks, and that's something that a lot of the Eastern countries have been very used to doing because they've faced something like this before. So I think that desire to blanket lock down an entire country just isn't there anymore, and so we probably we'll see some slowing in the economy and some volatility in markets, but we're not expecting that short, sharp collapse that we saw earlier on.
Okay, great. And what about the Australian share market, Isaac? I mean, it's sort of rebounded quite strongly. There's sort of talk about question marks about how high it could go over 2021 and beyond. What's your view on that one?
Yeah, guessing the share market is something that makes fools of all of us economists and strategists. And I think back to 2019, I guess, where the broad consensus was for the market just to tear higher, and that's been proven largely wrong. Now I think there is perhaps a little bit more certainty about the outlook than there was in 2019. And our view around the Australian stock market is that it looks attractive now. It was attractive 6 months ago. It was very attractive 6 months ago. Now it's just attractive. In terms of what that means for returns, we do try and quantify what we think an average return over the next 5 years is. And we do it over 5 years because a 1 year period, it can be so noisy. We've seen in the past 20% plus years followed by a 1% year. And so we try and think about an average over the next 5. And we're pretty optimistic. We think it could be sort of 8 to 11% average over the next 5 years. And that's higher than the historic averages. So it makes it an attractive proposition. And I'm not sort of falling into the trap of saying it'll be 7,000 by the end of next year or anything like that. But if you do the math of a 10% average return over the next 5 years, you're getting to record highs well and truly.
Yeah. And what's your approach to just balance all the risks with the return potential on offer?
We always think about risk-adjusted returns because naturally assets that have high returns are more risky. There's no free lunch in investing like that. So, I mean, you can see on the slide deck that we have, we think that returns are going to be high in equities. But we actually mean by that is risk-adjusted returns will be higher than history. Similarly, in credit, we think risk-adjusted returns will be higher than history. And so we like to lean towards those assets where risk-adjusted returns are high. In contrast, government bonds, which nobody liked back in 2019, were one of our largest allocations because we thought that there would be a recession and we thought risk-adjusted returns would be high. Returns would still be relatively low because it's a low-yielding asset class, but it was an important part of the portfolio. So we need to balance out the risk very much so. We don't just focus on returns. We do think about which asset class will give us the best pathway and the best journey.
Right, excellent. I've got one question here that's come through from Denise, and it may be our last. We'll just see how we go. Denise had, what would be the market sentiment, and you spoke about Donald Trump, if he refused to concede, which is sort of playing out now, and all these legal disputes?
Yeah.
Denise has got a question about that.
Yeah, it's so difficult to tell because he could refuse to concede, but there are, of course, processes in place in the US to deal with that, and that was sort of written into the Constitution and into the law. It matters how he refuses to concede if that happens. Does he mobilize a militia? How ugly could it get? I think if President Trump refuses to concede and follows due process, and there's a ruling and he's found to not be the president and he leaves in disgrace but still leaves the White House, I think markets can deal with that, and they're probably building that into their price now as we speak. If, on the other hand, it results in social unrest, and we've seen what social unrest looks like in the US, we see images that are probably editorialized, but they look like third world images, not the first world. If that obtains and we see more of that, then it could be a pathway to volatility, and I'm sure it would be if militias mobilize and President Trump refuses to exit that White House in a more aggressive fashion. That won't be good for markets.
Well, hopefully that doesn't happen. Hopefully that doesn't happen. Excellent. Well, look, I think we are approaching 1 o'clock. I think we'll call it now. So where are we? First of all, thanks everyone for sending through those questions, and we also are really keen for your feedback about today. So please speak to your advisor. We are looking to do some regular webinars over the course of 2021. So yeah, it would be just absolutely terrific to get your feedback through your advisor of any additional questions that you've got. And then on just in closing, we have recorded the webinar, as I mentioned earlier, for some of our other clients, but if you are seeking a copy later on, again, let your advisor know. Then other than that, I just want to say thank you on behalf of Endorphin Wealth. First of all, to clients who attended today, it's much appreciated. I hope you got some value from it. I sure did. And I also want to say thank you from Endorphin Wealth to Isaac from Oreana for taking time to take us through the sessions today and answer some questions on his feed as well. So I think if everyone's happy with that, we might wrap up today's session and let you get on with your day. But thanks once again, and enjoy yourself. Thank you.